Assalamu alaikum once again, and I'm sorry for the interruption. My PC got hanged. That's why I had to end the previous session in the previous video. And starting with the now corporate governance part again, right? As previously I stated that the company does not have to comply with the corporate governance requirement as it is not a listed entity. However, it is a good practice to have an established audit committee. Okay, especially for large companies like Pale Company, which is seeking a stock market flotation in the relatively near future. The international audit team is small and acting in an independence as they report directly to the CFO. This means that the scope of their work is likely to be quite limited due to insufficient resources, and any recommendations may could potentially be ignored by the market. This has implication for controls any uh, and for controls over financial reporting, for controls over financial reporting, which could be deficient and increases control risk. There is a high score for errors in financial reporting and for deliberate manipulating manipulation of balances and transactions, as the internal auditing does not have sufficient resources for through monitoring and reporting. Pressure on results. Now, again, we got 2 marks over here. So far, we get, as you can see, in this B requirement, we get for new client, we get 2 marks. For corporate governance, again, we get 2 marks out of 20. Now, pressure of results. The company is not a listed entity, but the existing and new shareholders will be looking for a return on their investment in the form of dividend payment, right? So, the company is not a listed entity, but the existing and new shareholders will be looking for a return on their investment in the form of a dividend payment. In addition, in the run-up to a potential stock and flotation, there will be pressure for the company to show good financial performance. Further, what we'll say that company also has an ambitious international expansion plans, pressure to return a better performance create an incentive for management bias, and which means that management may use earnings management techniques or other methods of creative accounting to create a healthier picture of financial performance. Uh, than is actually the case. This creates an inherent risk of a material misstatement at the financial statement level. Got it? So the company also has ambitious international expansion plans, pressure to return a better performance creates an incentive for management bias, which means that management may use earnings management techniques or other method of management, uh, other methods of creative accounting to create a healthier picture of financial performance rather than is actually the case. This creates an inherent risk of uh, material misstatement at the financial statement level. So far, so good. We get 2 more marks, and we have 6 marks till now. Now, next point is government grant. So, a government grant of $20 million has been awarded to bail the bank. This amount to 3.6% of total assets and is material to the projected statement of financial position. See, that's the M, the materiality part. Now we will discuss the accounting treatment. First, let us connect it with the scenario. Markov has suggested that suggested that he will recognize dollar 10 million. Wow, 10 million of the amount received in the profit for the year. And further, projected profit before tax PBT is only dollar 6.5 million. So increasing the profit by this amount would be highly material to the statement of profit or loss. Now we will discuss about the accounting treatment. IS 20 requires that government grants are recognized in profit or loss on a systematic basis over the periods in which the entity recognizes expenses for the related cost for which the grants are intended to compensate. So mark out is intended to recognize the half of the ground or half of the grant as income this year. However, this is not appropriately justified. The grant has not been awarded to compensate for management time in planning the international expansion. So the appropriate accounting treatment would seem to be that the entire amount of the grant should be recognized as deferred income should be recognized as deferred income in this financial year as the expenditure for which the grant is specifically provided has not yet been incurred. Therefore, there is a risk that company will recognize the income too early, leading to overstated profit and understated liabilities. Now see, in this part, what I did first, I explained about the materiality, right? Then I connected with the scenario a bit. Then I explained the relevant accounting treatment, connected it with the scenario again, and then I discussed about the impact on the scenario and the audit risk, which can be raised, right? So 3 marks for it, and in total so far we get 9 marks, and we need 11 more marks. Legal case is the next part to discuss. So the legal case could also give rise to a risk of understated liabilities or inadequate disclosure if the company fails to provide fails to provide fails to provide for the 19 million for the 19 million claimed by the employees or to disclose the matter as a contingent liability. It will be a matter of significant judgment to decide whether the legal claim is likely to against parent company or not at this early stage. However, the matter is material at 3.5% of total assets, and being close to 3 times projected profit for the year. Therefore, warrants careful consideration. So far, so good. Legal case, again, we got 2 marks for it, and overall, we covered 11 marks. Now, reduction in fair value of timber plantation. How much we will get in 11 marks then now. The company's timber plantation asset prior to recognize any change in fair value is projected to around 90.9% of the company's total assets, and therefore it is highly material, right? So the company's timber plantation asset prior to recognizing any change in the fair value is projected to amount to 90.9% of the company total assets, and is therefore highly material. The companies correctly obtained an expert opinion on the change in fair value of the destroyed and destroyed and damaged trees caused by the storm. The expert valuation has helped management to determine that a reduction in fair value of how much dollar 70.5 million should be recognized in the financial statements within profit. This amount is material in its own right at 14.1% of the timber plantation asset, and weighing more than 10 times project profit when the loss in value is recognized. It will turn the projected profit into a significant loss. There is a risk that management will not recognize the loss, will not recognize the loss in full due to the impact it will have on profit. This is therefore very significant issue for audit planning. Further, there is risk that expert valuation is not appropriate. For example, if the expert does not have appropriate expertise to perform this specialist valuation, which would lead to issues in whether the valuation can be relied upon. Additionally, the expert has considered only the value of destroyed and damaged trees and not considered any other impact of the storm. For example, if other assets such as roads and buildings have been affected by the storm and should be tested for impairment. Therefore, sorry, let me get the spellings. Yeah, now, therefore, based on issues discussed above, there is a risk that the loss is not fully recognized in profit for the year, and the carrying amount of non-current assets is overstated. Now, see, such scenarios, such part of the question in which we getting multiple issues, as you can see in this part, we get the issues related to the fair valuation of the timber plantations, the experts issue, the other experts issues, and then the issues of related to the other assets impairment. We have multiple issues in this part. Now, this will give you around 4 to 5 marks, right? And so let us consider it will give you 4 marks. Based on that, how much marks we got till now? New client 2 marks, corporate governance 2 marks, pressure on results 2 marks, 6. Government grant 3 marks. So that's 9. Legal case 2, 11. That's 4 marks. So 15 marks so far. Let us discuss about the inventory now. Now the level of inventory increased significantly by 67.4%, and the value of inventory at 30th June 2005 represents 2.8% of projected total assets. The inventory is therefore material to the financial statements. Okay. So there is a risk that if the industrial action continues and the company cannot fulfill its export sale contracts, cannot fulfill its export sale contracts, the customer will cancel their orders. The inventory may not be saleable to other customers after that. Perhaps if the timber has been cut to customer specification or requires modification to secure a sale to a different customer. Okay, secure a sale to a different customer. Specifications, sorry. So now, according to IS2, inventory should not be recognized at the lower of cost and net realizable. Sorry. Realizable value, and there is an audit risk that inventory is overstated if any necessary written down to net realizable value is not recognized. This would result in overstated current assets and overstated profits. So far, so good. We will get 3 marks for this. Firstly, we discuss about the materialities, and we discuss about the risk of which can be arise due to an industrial action, and then we discuss about a little bit about the relevant standard, and again, we told about the impact and the risk. Fine. So this will bring us to 18 marks, and finally, we'll discuss about the going concern. Get it done with this question till here. Now going concern. So what we'll say that there are several indicators despite the projected increase in revenue and profit. The company faces going concern problems. These indicators include operational problems, including destroyed timber plantation and industrial action, reputational damage caused by the legal name, and possible illegal payment. Financial problems caused by the lack of cash and the fact that its results are likely to be much more worse than that projected by management. When the decrease in fair value of the destroyed timber plantation is taken into account. Okay. Lastly, We will discuss about the in this scenario IS1 requires that management provide a note to the financial statements which discusses any material uncertainty over the company's ability to continue as going concern. So if the company fails to disclose this note or sorry, or provide provides the note but with inadequate details, then the requirement of IS1 IS1 may not have been followed, creating a significant audit risk. So far, so good. We are done with it, and finally, what we did, we discussed about the sale, about the going concern issue, why we connected it with the scenario, discuss the issues, and then finally we discuss about the relevant accounting standard for the going concern. That's it. That's how you need to draft the answer. Simple technique which I followed throughout the scenario. Now, what you need to do, you need to practice a lot of questions in your remaining days of practice so that you get a little expert at how to draft the answers with the appropriate exam technique, right? So far, so good. This recording will be available on my YouTube channel, which is www.youtube.com/accountancy. Okay. Well, also, if you need this handout, what you need to do, you need to save this number plus 92 334 1777706 with name of accountancy and WhatsApp me with your complete full name. Then I will provide you this handout to you guys, right? Also, do follow us on our Facebook page, which is this, right? See you very soon with the next prepared session of AAA. Please have an exam in our next session very soon. For that, keep following our YouTube channel and Facebook pages. See you soon then. Take care.